Today I will tell you how to figure out if a stock is worth buying, how to value a stock, how to determine if the underlying business is a wonderful one or not. I will bring my real life examples on various stocks like Facebook, Kraft Heinz, Salesforce. This is episode number 3. Stay tuned. Hi, I'm Henrik from Value Investing. In this video you will learn how to read financial statements like an ABC, how to know when companies hide their real performance, and how to predict companies' future based on their financials. You will get an enormous value in this video. You will learn about the most important accounting tricks and business strategies that other investors sell in their courses for a few $1,000s, but my audience should get it totally free. This topic is not a single video, it is a series of videos with episodes so that we can go over each part of my full investment analysis I do before buying a stock, and I will go over each one of them in detail so that I can bring in full value. I will show our full investment analysis step by step, what exactly we do before buying a stock. This is episode number 3, which is about our number 2 study, and the title is Financials of the Company. If you have missed our previous video, you can go back to our videos and find the video with the same title and start watching them from episode number 1. Or you can just click on the card here to open the playlist. In our introduction video, the episode number 1, I announced that we have 4 investment studies we do before we can determine if a stock is worth buying or not. Those 4 studies are: number 1, understanding the business; number 2, financials of the company; number 3, CEO of the company; number 4, price of the stock. We will go over each study in detail, but this episode number 3 is all about our number 2 study, about the financials of the company. But before we start, please make sure I'm not a financial advisor and I don't provide any investment recommendation. And in this video, which has an educational purpose only, I only share my thoughts about various stocks. Before you invest in anything, do your own research and analysis. Also, make sure you subscribe to this channel to receive our weekly videos if you want to expand your financial skills. I will bring real life examples on Facebook, Kraft Heinz, and Salesforce companies, which will tell you a good story. Okay, let's start. When I want to get familiar with the company's financial numbers for the first time, I open the company's page in Yahoo Finance and go to the statistics section to get a fast introduction to the company's financial well-being. And I also check if I can find some red flags there. If I find a few red flags there, I instantly close it. I don't want to make risky gambling investments. A red flag shows a potential problem with the financial well-being of the company. A typical red flag can be a high debt to equity ratio. When the ratio shows that the company has more debt than its equity, it's already a red flag. But this is not a dogma, as there are some business types that handle debt perfectly, like businesses based on real estate, as real estate is a great place to leverage your growth and it's perfect for borrowing long-term debts like 35 years, which can easily be covered by income. The next red flag can be low cash in hand. I look at total cash, or more often total cash per share, to understand if the company is protected for a rainy day or not. The other red flag can be the current ratio. The current ratio basically is the result of short-term assets divided by short-term liabilities. I'm looking for a company that has this ratio of at least 1 and preferably 2, because if it's under 1, that means that the company will have some short-term liabilities which can't be paid with their short-term resources. So it is very important. A lot of companies go broke because of this. Warren Buffett's quote is, "It's only when the tide goes out that you learn who's been swimming naked. This is about the economic recession times when companies don't have this current ratio above 1. A lot of them just go bankrupt because of the lack of liquidity. Ideally, a wonderful company must have near to zero debt, or it can have some little debt if the company has proved they can use it wisely. Okay, to get familiar with the company, I also fastly check the revenue per share, earnings per share, book value per share, dividend yield, and some others. And if company interests me, like I couldn't find obvious red flags, only then I want to dig deeper. To dig deeper, next I go to the section called Financials, where you can find 3 base tabs, which are the income statement, balance sheet, and the cash flow statement. There are too many things to look into those statements, but I will describe what I mostly care about. I care about consistent growth in 4 numbers, which are the revenue, net income, equity, and operating cash flow. To check those numbers, let's go to the income statement first and find the total revenue. Okay, here for Facebook we clearly see that in 2016 the company had over $27 billion as revenue, in 2017 over $40 billion, in 2018 over $55 billion, and in 2019 over $70 billion. This is a typical example of consistent growth. Next, let's look at the net income. And again, we can see consistent growth. In 2016, we had over $10 billion, in 2017 over $15 billion, in 2018 over $22 billion, and in 2019 we had over $18 billion, which should be over $23 billion if the company wouldn't have the one-time fine payment of roughly $5 billion. So we clearly have consistent growth here also. Let's go to the next tab, which is the balance sheet. We scroll down here to find the stockholders' equity, and we see that the company had over $59 billion in 2016 and consistently growing annually to $101 billion in 2019, which is again a great and consistent growth. Okay, let's roll to the final most important numbers in the cash flow statement and find the row called net cash provided by operating activities, or in other words, the operating cash flow. So we see the company had over $16 billion in 2016 and consistently growing annually to over $36 billion in 2019. I think you already guessed why I love this company. Also, I want to state that this is only 4 years data, but we need 10 years data to be more clear on our study, so I often use the Rule 1 Investing and Macro Trends websites where you can clearly see enough historical data. There I need to see those 4 numbers, the revenue, net income, equity, and operating cash flow, to be clearly growing for at least 10% yearly, and I take 10, 7, 5 and 3 years data for that. The next important thing we must take into consideration is ratios like ROE, return on equity, and ROI, return on investment, or ROIC, return on invested capital. What are those? Those are ratios that show the money earned by company compared to the total equity or total invested capital. This is to understand if the company is spending the resources wisely and effectively or not. The ROE, return on equity, is almost the same as cash on cash return when you invest in real estate. Let's say if you want to invest in a real estate and you want to understand if that current real estate is a good investment or not. What do? You calculate the total annual rental amount and divide it to the total amount you invested to understand the cash on cash return. Doing so, you understand what percentage of cash you can expect annually based on what you paid. At the end of the day, by doing this, you understand how long it will take to get your full money back out of the deal. So it's the same for the companies you invest in. You need to know how much company earns money as a percentage of their total equity or total invested capital. By doing so, you understand if the company spends its resources wisely or not. So we would like to see those ratios to be at least 10% and consistently. And the ROE and the ROIC should not differ from each other vastly, as we don't like to deal with companies with high debts. And the main difference between equity and the invested capital is the company's debt. So if there is near zero debt, that means that equity and invested capital numbers are very alike. That means that the ROE and ROIC are almost the same. The question is where we can find those historical ratios. The answer is that it is on many financial websites, but mostly I use again Rule 1 Investing and Macro Trends websites. Here is an example from rule1investing.com, where you can clearly see the historical ratios of Facebook, and you see it's more than 10% for 7, 5 and 3 years. And here is an example from macrotrends.net, where you see the same historical data for Facebook, just on the chart. Another thing I want to show is that in the cash flow statement, we also want to see the main sections be positive, negative and negative. What does that mean? Let me explain. The cash flow statement consists of 3 sections: the operating activities, the investing activities, and the financial activities. So we want to see positive numbers in the first section, which is the operating activities, which shows how much cash the company earned at the end of the day. We want to see negative numbers in the second section, which is investing activities, because we mostly want the company to invest that earned money, not to save. We can save money ourselves. Why we gave the money to them. And in the end, we want to see negative numbers in the third section also, which is the financing activities, as we don't want the company to borrow money all the time. Instead, we want to see the company paying back the financial liabilities. So remember, the cash flow statement is based on 3 sections, where we want to see positive, then negative, and then again negative numbers in the summary of the main 3 sections: positive, negative, negative. By the way, hit the like button. That like button is really important for us if you'd like to support this channel. Let's quickly look at the most important numbers of financial statements and see if we can find consistent growth for Facebook, Kraft Heinz and Salesforce companies on charts of Macro Trends website. Okay, let's see Facebook's revenue. Here we see what we want to see. It has growth and consistency. Let's look at net income. Okay, same here. We see growth and we see consistency. Let's go to the balance sheet to see shareholder equity. Okay, same here. We see growth and consistency. And let's move on to the fourth important thing, which is cash flow from operating activities. Fine, we again find enough growth and consistency here. Now let's do the same thing for Kraft Heinz. Okay, let's search for the company and go to the income statement to see the revenue. Okay, we see some growth, but no words about consistency. Let's check the net income of Kraft Heinz. Positive and negative numbers, can't see growth or consistency here. Let's go to the balance sheet to check the shareholder equity. Oh, we see some growth, then we see it drops again and no consistency here. Now let's visit the final important section, the cash flow from operating activities. Okay, this is maybe something close to what we want to see, but again not fully. Okay, now we understand the financials of Facebook and Kraft Heinz. I just wonder why Warren Buffett bought Kraft Heinz. Surely I'm not going to own any shares. I don't say the price will not go higher, because that can happen to any stock. I just want to say we need to know exactly what we do, and we must do the right things that should be reasonable enough for investing in the long term. Maybe Warren Buffett knows something that we don't know, or maybe he has some hedge positions there, as we can't know his short position. Also, he owns preferred stocks, which are different from the common stocks. Usually we don't look at the prices of the shares in this stage while doing the investment analysis study number 2, because we don't care about the share prices in this stage. What we care about at this stage is if the business is good one or not. The stock price doesn't show that for sure. Stock price shows what others think about the business's future. But let's make an exception this time and quickly look at the price history of Facebook. It seems Facebook is in its long-term bullish trend with consistent growth. Now let's look at the price history of Kraft Heinz. I think you clearly understand the reasons behind these price movements now. Also, Warren Buffett admits he paid too much for Kraft. If I'm not mistaken, he paid a few times more than the current price of the shares, which means he really overpaid for it. And this is why we don't buy stocks only because other authorities like Warren Buffett buy it. And this is why we do our own research and analysis and teach the same to you. But we also don't ignore their thoughts for sure. Okay, let's quickly move to see what Salesforce company has in its 4 most important numbers, because I want to teach you a valuable lesson for what people pay thousands of dollars in online courses to learn this. Okay, as usual, we go to the income statement to see the revenue. Okay, here it is, and we can find enough growth and consistency. It seems we have a wonderful company. Let's check net income. Oops, we don't like the net income very much, but we see some growth there, but no consistency. No words about that. The next one is the shareholders' equity, which is in the balance sheet. Oh, we see great growth and consistency, yeah? Good. Let's move on to the cash flow statement to see the numbers for the cash flow from operating activities. Yeah, you think this is really a company we like to see from first sight? Okay, let me teach you some tricks so that you don't get caught in a trap like this. First and foremost, we need to see all 4 numbers: revenue, net income, equity, and operating cash flow, to have growth and consistency in all of them, not any of them or most of them. All of them should be good ones. If we don't like the net income in this case, we must know the reasons behind it. There can be cases that it's okay, but I think it's not okay for this case. Let me explain. For example, this company has a big expense which is called stock-based compensation. This is in reality a non-cash expense for the income statement. So you can pay employees via salaries or via this compensation. In both ways, you register the expense in your income statement. However, if you pay via non-cash expenses like the stock-based compensation, you add that amount back in the cash flow statement, as that is a non-cash expense. So this way you make your cash flow from operating activities to look nicer. As many people look at these numbers only, right? The cash is the king. We heard that a lot. Okay, so this is why we need all 4 numbers to be cool, not some of them. The revenue, net income, equity, and operating cash flow must be good enough. The next important thing you must look at to know if a company is fooling around or not is the history of the outstanding shares. Let's open the chart to see the history of outstanding shares of Salesforce. Holy mackerel! What does this company do? This company is adding shares all the time. They sell more shares every year, collecting more money from investors. They just attract new money all the time, selling new shares, bringing new money to the business. This is an inflation of shares. They raise capital each year like crowdfunding, so they grow the equity with the investors' money, not from the business operations, not from the operating activities, but from just selling shares. I don't say this is bad for the company. They are not stealing money, as the money they bring in from investors make the business even bigger. But the problem lies elsewhere. The problem is that we don't see the real performance of the business. The equity growth is not the result of the business performance. It is not the result of business operations. It's like drawing good numbers instead of showing the real performance. We can't see the real performance of the business activities looking at the equity only. You can't judge this company's performance based on equity growth. Looking at Facebook shares, we see that the equity of this company grows based on business performance. They have income, they have expenses, and a certain amount of money is left after covering the expenses, and that money makes the equity of the company grow because they don't add shares all the time. So usually looking at equity growth, I can guess almost how much money the business brings to the owners from business operations. So this way I can judge if the company is doing well or not. But if the equity mostly comes from new sales of shares and not from business performance, that's telling more about the CEO or about the accounting or maybe sales team rather than the business performance itself. I know what Facebook will do in 10 years. I know where the income will come from and how much it will be. But I don't know what Salesforce will do in 10 years. I don't know if that company will still be able to sell new shares in 10 years at the same pace or not. So I can't predict if the equity will continue growing in 10 years or not. Another question is, what will the company do if the share prices drop vastly? Will they continue to sell new shares? So if they continue, it talks about bad management that sells company shares while it is undervalued. So the company gives high value and takes less value. We need to own companies that buy their own shares back when the share prices are low, not sell more. Okay, let's say the company will stop selling the new shares. Then what will happen to the equity growth? Will it die finally? Okay, I don't want to blame much, judge it yourself. Just I want to invest only in those companies that show the business performance well enough to the investors and do the best for investors to understand the business perfectly. We don't buy businesses, we don't understand their strategies, and we don't buy businesses that the shares are subject to inflation. Okay, the lesson is clear. We need 4 most important numbers to grow consistently, and all of them. And we need companies that don't add shares all the time. Instead, we need companies that even sometimes buy back their own shares. That's it. Let's go over it again. The 4 most important numbers are the revenue, net income, equity, and the cash flow from operating activities, or in other words, the operating cash flow. Also, analyzing a dividend paying company's equity growth is a little different than that of the one that doesn't pay dividends. You must make sure you add dividend payments back to the equity when seeking for equity growth, because when companies pay dividends, that dividend amounts are deducted from the equity. So when judging the equity growth, you must add dividends to it as well. Okay, the conclusion is, if we see all 4 important numbers of a financial statement to have consistent growth, then it's almost a guarantee that the company is not cooking books, because it's almost impossible to do that and have all 4 numbers look good. Of course, if they are not just drawing the numbers and lie, but that is not our job. That is the job of SEC to find out if the numbers are real or not. If we see that the company is doing well on these 4 important numbers, that means that the company has an economic moat, or in other words, a competitive advantage. And we need to invest only on those companies that have a durable competitive advantage. You must find out what type of competitive advantage your company has and stick to it, keeping it in your mind all the time, because only that advantage will keep your company from economic downturns and protect in competitive battles. The next episode, number 4, is all about our study number 3, which is CEO of the company. Watch it to know how you can research and learn about the CEO so much that you can gain enough confidence that he or she can thrive the business the way you want to see. A lot depends on the CEO. You need someone whom you absolutely can trust. Now please make sure you subscribe and hit the bell icon to get notifications when I upload the new video so that you don't miss it. And if you could take any value from this video, please hit the thumbs up button and share with your friends, and don't forget to leave your comments below, as I really want to know what are your most important numbers in a financial statement. Thanks for watching. Watch the next video.